What is happening, crypto fam? Welcome back to Bitcoin Bulletin, your ultimate source for the pulse of the market. The news cycle is absolutely on fire right now, and if you're not plugged in, you're missing out on some seriously game-changing moves. We've got seismic shifts in global finance, whispers from legendary investors, and strategic plays that could redefine your portfolio. Get ready, because we're diving deep into the stories that everyone will be talking about. You do not want to miss this one. Stick around. First up, we're talking about the big players and their warnings about the very foundation of our financial system. Is the dollar on its way out? And if so, what does that mean for your assets? We're breaking down expert analysis that points towards gold and, yes, Bitcoin as the ultimate safe havens in turbulent times. Get ready for some eye-opening insights. Then, we're shifting gears to a critical technical level for Bitcoin. We're talking about a major resistance point that could send prices soaring or trigger a sharp downturn. Is this the breakout we've been waiting for, or are we heading for a breakdown? We've got the charts and the analysis to help you understand what's really going on. Next, we're looking at how institutions are locking down Bitcoin like never before. The supply is tightening, and this could have massive implications for price and accessibility. We'll explore the data that shows Bitcoin being moved into long-term storage, creating digital fortresses that could significantly impact market dynamics. And finally, we're diving into the potential impact of a major economic policy shift. Could a key central bank decision this month be the catalyst that sends Bitcoin prices into the stratosphere? We'll analyze the forecasts and the historical patterns to see if September could be a massive month for crypto. Don't go anywhere. Hit that like button, subscribe if you haven't already, and ring that notification bell so you never miss an update. Let's get into it. The dollar's slow decline, a warning from a legend. Is the foundation of global finance about to shift? Billionaire investor Dalio is sounding the alarm, warning that the US dollar is caught in a big debt cycle that is nearing its end. This isn't just a casual observation. Dalio, the former CEO of Bridgewater Associates, a firm managing billions, is suggesting that the dollar's long reign as the world's primary reserve currency could be under serious threat. He points to the staggering U.S. national debt and a persistent annual deficit as major red flags. The government is spending trillions more than it earns, forcing it to issue trillions in new debt each year, with interest payments alone consuming a massive chunk of the budget. This relentless borrowing and the potential for continued monetary easing, like quantitative easing, could devalue the dollar, diminishing its purchasing power and its appeal to global investors. In this climate of economic uncertainty, investors are increasingly looking for assets that can hold their value. Dalio specifically highlights gold and, intriguingly, Bitcoin as potential hedges against this fiat devaluation. He suggests a strategic allocation of around 15% of one's portfolio to these scarce assets, drawing parallels to historical currency collapses in the 1930s and 1970s. The data is already starting to support this thesis. While gold has seen a resurgence, with central banks increasing their holdings and its share of global reserves hitting a 30-year high, Bitcoin has delivered even more explosive returns. Over the past 12 months, Bitcoin has seen its price double, significantly outperforming gold's impressive 42% gain. This stark performance difference underscores a growing sentiment favoring digital scarcity and decentralized value storage over traditional, government-backed currencies that are susceptible to inflation and policy decisions. Dalio's analysis goes further, suggesting that central banks are in a lose-lose situation. They can either raise interest rates, which could trigger widespread defaults due to the high debt levels, or they can continue to print money, further devaluing existing currency. Both paths pose significant risks to the dollar's credibility. Even stablecoins, often backed by U.S. Treasuries, face systemic risk if the underlying assets themselves lose value. The market is clearly responding to these concerns. We're seeing a broader trend of investors moving towards what is often termed hard money, assets that are not easily diluted. This includes not only the traditional safe haven of gold, but also the digital alternative, Bitcoin. The implications for the average investor are profound. As traditional financial systems grapple with unprecedented debt loads and the potential erosion of currency value, Understanding these shifts and considering assets with limited supply could be crucial for preserving and growing wealth in the coming years. But what happens when these digital fortresses start to attract massive institutional capital? We'll explore that next, as ETFs continue to reshape the market. Bitcoin's crucial juncture, a technical showdown. Bitcoin is standing at a precipice, a critical resistance level that could determine its short to medium-term trajectory. We're talking about the $112,000 mark, a level that has historically acted as a significant barrier. Breaking through this could signal a powerful continuation of the bull run, potentially propelling prices even higher, fueled by sustained demand and positive market sentiment. However, failing to conquer this resistance could lead to a sharp correction, a breakdown that might see prices retreat as sellers take control. The recent price action has been driven by a confluence of factors, including strong inflows into spot Bitcoin ETFs, which have accumulated a significant portion of the circulating supply. These institutional vehicles now hold over 1.29 million BTC, representing roughly 7% of all available Bitcoin. This institutional adoption is not just about buying power, it's also about supply dynamics. As more Bitcoin is locked into these ETFs and held by long-term investors, the available supply on exchanges dwindles. This reduced liquidity, combined with active accumulation by whales, large holders of Bitcoin, creates a tighter market. When demand outstrips this constrained supply, price appreciation often follows, as evidenced by Bitcoin's performance exceeding 88% year-over-year. The narrative around Bitcoin is further bolstered by the potential for monetary easing from central banks, particularly the U.S. Federal Reserve. Anticipation of a rate cut, even a modest 25 basis points, is expected to inject liquidity into the financial system and weaken the U.S. dollar. Historically, a weaker dollar correlates inversely with Bitcoin's price, making it a more attractive investment for global capital. This macroeconomic backdrop is crucial, especially as we approach historical periods of seasonal weakness for Bitcoin, often seen in September. However, the current environment, marked by strong institutional accumulation and the prospect of lower interest rates, suggests that this year might defy those bearish seasonal trends. While Bitcoin's performance has been robust, the cryptocurrency market is diverse. Ethereum ETFs, for instance, have faced a more challenging year, with significant year-to-date losses despite recent inflows. This contrast highlights Bitcoin's unique market position, driven by specific catalysts like the spot ETF approvals and the ongoing narrative of digital scarcity and a potential hedge against inflation. The resilience shown by Bitcoin, even during periods of broader market uncertainty or seasonal headwinds, points to a growing structural demand that could be pivotal in overcoming the $112,000 resistance. The interplay between institutional adoption, on-chain data, and macroeconomic policy will be key to watching as Bitcoin approaches this critical technical level. But even with this institutional buying, where is all that Bitcoin actually going? We're going to explore how these assets are being locked away, creating digital fortresses. Institutional hoard, Bitcoin locked away in digital fortresses. Something significant is happening behind the scenes in the Bitcoin market, and it's all about custody. Major financial institutions are not just buying Bitcoin, they are locking it away in long-term storage, creating what can only be described as digital fortresses. This trend is dramatically reducing the available supply on exchanges, a move that has profound implications for price discovery and market dynamics. We're seeing record levels of institutional custody, with firms like Anchorage Digital and Galaxy Digital reporting massive inflows, with Galaxy alone safeguarding over $1.8 billion in Bitcoin. This isn't just speculative trading. It's strategic asset allocation by traditional finance players entering the crypto space. The recent surge in spot Bitcoin ETFs has been a primary driver of this phenomenon. These ETFs have seen record inflows, pushing Bitcoin's price above $111,000 and amassing a total of $141.75 billion in assets under management. BlackRock's IBIT alone holds nearly 750,000 BTC, and Fidelity's FBTC holds almost 200,000 BTC. Combined, US-based ETFs now control approximately 1.29 million BTC, which is about 7% of the total circulating supply. What's crucial here is the low turnover ratio. Reports indicate it's around 0.0299. This suggests that the vast majority of Bitcoin acquired through these ETFs is being held rather than actively traded. This set it and forget it approach by large institutions effectively removes these coins from the market's active circulation, creating a scarcity effect. This tightening of supply is amplified by the actions of whales, or large Bitcoin holders. On-chain data shows that new cohorts of whales have been accumulating significant amounts of Bitcoin since March, further reducing the readily available supply. This coordinated buying pressure from both institutions via ETFs and large individual holders creates a powerful demand-side force against a shrinking supply. Historically, such conditions have often preceded significant price rallies, as the limited availability makes each new purchase more impactful. In contrast, while Ethereum has also seen institutional interest, its related ETFs have not performed as strongly, with substantial year-to-date losses for some funds. This divergence highlights Bitcoin's unique position, driven by its scarcity narrative and its adoption as a digital store of value, often referred to as digital gold. The expansion of custody services by established players like BNY Mellon further solidifies the infrastructure for long-term holding, making it easier and safer for institutions to commit capital. If current trends continue, analysts predict that ETF holdings could surpass 2 million BTC by 2027, consolidating institutional dominance and potentially transforming Bitcoin into an even more tightly held asset. This strategic hoarding by institutions is a critical factor to monitor, as it directly impacts the supply-demand balance that governs Bitcoin's price. Now, with all this institutional capital flowing in, what's the broader economic backdrop that's making this happen? We're looking at the potential impact of a major central bank decision that could send ripples through the market. Fed's potential rate cut, a September catalyst for Bitcoin. As the financial world watches the U.S. Federal Reserve, a potential rate cut this September is emerging as a significant talking point for the cryptocurrency market, particularly for Bitcoin. Currently trading around $111,190, Bitcoin has already seen an impressive year-over-year increase of over 88%. The market widely anticipates a 25 basis point rate cut from the Fed, a move that is expected to inject substantial liquidity into the financial system and simultaneously weaken the US dollar. This macroeconomic environment is traditionally viewed as favorable for risk assets, with Bitcoin often benefiting from a depreciating dollar and the reduced cost of borrowing. Analysts are pointing to this potential Fed action as a critical tailwind for Bitcoin's price, especially in light of historical seasonal trends. September has often been a challenging month for cryptocurrencies, frequently characterized by selling pressure as institutional investors rebalance portfolios and engage in tax loss harvesting. This phenomenon has led to the term Red September. However, this year's narrative may be different. The unprecedented level of institutional accumulation, evidenced by the record number of whale addresses holding over 100 BTC, suggests a strong conviction that monetary easing will reignite a broader crypto bull market. These large holders appear to be betting on the Fed's move to stimulate demand and potentially offset the typical seasonal downturn. The anticipated rate cut is projected to lower Treasury yields, making riskier assets like Bitcoin more attractive compared to safer, lower-yielding investments. Firms like Blockbyte are predicting that such a move could not only boost Bitcoin, but also trigger an altcoin rotation, where capital flows from Bitcoin into other cryptocurrencies, potentially benefiting assets like Ethereum due to its ongoing network upgrades and scalability improvements. The weakening dollar, a direct consequence of accommodative monetary policy, has a well-established inverse correlation with Bitcoin's price, further strengthening the bullish outlook. On the futures market, open interest has seen a decline, but analysts expect it to rebound with improved liquidity conditions post-rate cut. While implied volatility in Bitcoin futures has been relatively low, a Fed cut could increase volatility and futures premiums, potentially attracting more institutional participation. It's worth noting the recent emergence of new crypto ventures, such as the Trump-backed World Liberty Financial (WLFI) token, which debuted with significant fanfare and initial market capitalization. While WLFI focuses on governance and community voting, it represents a different facet of the crypto space compared to Bitcoin's role as a store of value. The interplay between established digital assets like Bitcoin and emerging, politically backed tokens adds another layer of complexity to the market landscape. Meanwhile, other major cryptocurrencies are also showing activity. Ethereum is trading around $4,326 with robust daily transaction volumes, underscoring its utility for decentralized applications. Bitcoin Cash, Litecoin, and Ripple are also trading, indicating a broader market engagement. However, the inherent volatility of the crypto market cannot be overstated. Past performance has shown Bitcoin experiencing weekly losses of up to 20%, with even sharper declines in altcoins. This highlights the speculative nature of the market and the need for investors to balance risk with potential reward. The Fed's decision, alongside strong institutional demand and evolving market dynamics, will be crucial in determining Bitcoin's path forward this September. So, what's the ultimate takeaway from this whirlwind of news? We'll give you a lightning round recap and tell you how to stay connected. And that's a wrap on another explosive episode of Bitcoin Bulletin. We covered Ray Dalio's stark warnings about the dollar and the rise of Bitcoin and gold as hedges, analyzed Bitcoin's critical $112K resistance level, explored how institutions are locking away Bitcoin, and discussed the potential impact of a Fed rate cut on prices. Make sure you smash that like button, subscribe to the channel for more in-depth analysis, and hit that notification bell so you're always the first to know. Don't forget to follow us on all social media platforms for real-time updates and join the conversation in the comments below. Stay informed, stay invested, and we'll see you in the next one.